So like yourself, before you clicked into this video, I personally am also always very intrigued and very curious whenever a fellow content creator do some sort of an expose or portfolio breakdown and to basically show everyone where he's positioned, what's his current thought process, and maybe even his buys and sells. So likewise, in this video, I'll be sharing with you what are the updates from my previous episode, which was roughly 2.5 months ago. And as you can see, this type of videos always garner quite a bit of attention. And that's one of my selfish reasons of why I'm sharing. But anyhow, I think it also serves as a very good digital record or archive, and maybe in the future, look back and think how naive or how smart that investment decision would turn out to be. But before we get into the nitty-gritties, just wanted to share a quick fun fact. I wanted to wish a belated birthday to the investment legend, Mr. Buffett himself. Wanted to latch onto the fact that, hey, he's exactly 68 years older than me. And hopefully, I have more than 60 years of compounding ahead. But yeah, that's that. This portfolio is probably at least 3.5 years in the making in terms of my allocation and just continuous contribution to this portfolio. And on a simple percentage returns basis, 2.5 months ago, not anything spectacular because as you can see, my biggest conviction and largest allocation is still in Alibaba, and it's, I guess a lot of people like to call it dead money. It's not going anywhere, and because of that huge outsized allocation, it's basically pulling down the performance of the entire portfolio. And I think in some of the comments in that video itself, some people say that, oh, Chee Keng, why are you holding so many names? I think you're too diversified. I think I'm quite concentrated. If you just look at the top 5 positions, they work out to more than 70 to 75% of the portfolio. So I really don't think that I'm diversified. But the investing journey is a highly personalized one. You really need to look inwards and to know yourself. You need to kind of know what's your financial objectives, your risk profile, what you intend to achieve, how much money you're managing, is it large or small in comparison to your outlook in your life, etc. etc. So I think for now, this allocation, at least 2.5 months ago, I'm perfectly comfortable with it. I can sleep well at night. And I just wanted to do some housekeeping matters. I think this user called Hoiling, he or she put down this remark: anyone can use a spreadsheet and show off their portfolio. Try harder, Chee Keng. And I cheekily just replied, you really consider this showing off? I think this sucks though. Maybe next time I'll add in screenshots. I think I just forgotten to mention as well, why do I have so many positions that are in the smaller percentage basis? But I think it's just a general rule of thumb. Whenever I'm interested in a particular company, whether is it pitched to me by a friend, or I saw it online, or I was screening through some metrics, I really just wanted to add a small position so that I'm monitoring the company, because like they said, if you have no skin in the game, you probably wouldn't monitor it. So that has generally been my style. I add a bit and then I monitor the company, I build my conviction, and I slowly start adding to the position. Usually these positions are less than 3%, so it probably wouldn't move the needle. But anyway, back to this Hoiling person. Why I think it sucks, because if I really wanted to mix up some numbers, and the overall portfolio basis wise, I should be outperforming the index, give myself a 50% CAGR over the last 3 years, and say that I catch Alibaba in the bottom, and maybe I will trade Alibaba when it doubled, I sell out, and then I buy back again when it came down to $70. But evidently I'm not. I'm the typical buy and hold investor, and a lot of these positions are accumulated over the last 3 or 4 years or so. On the second part, I'm trying to add some screenshots. Really, because my numbers are all over the place, so it's quite hard to give you some sort of a consolidated view every single video. But anyway, I just wanted to kind of show you the breakdown. My previous portfolio update, I did cite 142,000 portfolio reflection. But anyway, just to keep the skepticism at bay, you can kind of add them up. These are denominated in Singapore dollars, and if you just convert, it's roughly around 153. So it's a little bit higher than the 142 that was reported in the previous episode, but a lot of them are in cash, and I'll explain more later on. But yeah, I think this hopefully gives you enough screenshot and evidence. And I try to be as transparent as possible, but sometimes it's just technically difficult. But that's not the main point. So this is my current portfolio breakdown, and you can see that in terms of cost, the total amount put in is around 135. The total valuations today is right around 140, and if you include the dividends, it's around 4.8. Because personally, I do keep track of all my past transactions, and whether is it selling at a loss or selling at a profit. So this will all come down to the dividend portion. So if you just add the two and then divide based on cost, the simple returns wise, is roughly around 7%. You can see that I didn't really move much of the portfolio. The two largest position is still Baba and Tencent. The core positions in the US tech, they're still there. But just wanted to give you kind of a bird's eye view on where I'm currently allocating my money. On a cost basis, China still makes up a majority at 65%. Fair value is at 57 because a lot of these positions have basically dwindled in value, and the US positions, because of that hyper bull market, it has kind of ballooned. At fair value basis, it's at 40%, and my Singapore exposure is at a measly 3-4% because of just my timing into the REITs position. But I think a large part that people often tend to forget or people tend to not share is really how much cash or how much dry powder you have on the sidelines. I think likewise, a lot of people have been citing Buffett's huge cash pile from Berkshire Hathaway, saying that, he's not being optimistic, he's maybe even bearish in the US market. So just to share in terms of the entire portfolio, if I include the cash position and do a division, my simple return actually dropped to 6%, but I don't really count this cash drag here because a lot of my cash positions are parked in high yield, maybe savings account or even money market funds. So that probably gives you more color and gives you a broader picture in how I look at the market. So you can of course argue that the US market is expensive, but I don't really like to kind of time in and out. I just buy whenever I see that it's undervalued. So that's just my own personal style. You don't have to follow that. So I think just to put a side-by-side comparison, 2.5 months ago, what changed? So I think the first thing that probably jumped out that catch your attention is the first major change in the Chinese bank position. So I basically sold out my entire Chinese bank exposure. So for those of you who are interested in my thought process on why I sold Chinese banks, I do document everything onto my Substack. I've already released a 2-part series. The first one, which shows my portfolio, and the second one, which dictates my entire piece and my theory behind why I sold Chinese banks. So overall, I think I'm up roughly 40%, give or take, inclusive of both capital gains and dividends on the Chinese bank positions over a 19-month period. I'll leave you to be the judge whether you think that it's a good or bad returns profile. But anyway, for those of you who want more timely updates, link is in the description below and you can just join the email list. Now on the second major change, I basically consolidated all my index exposure to VWRA. VOO and SPY basically tracks the S&P 500. They are listed in the US exchange. VWRA basically tracks the entire world's index and is listed on the London exchange. And you might ask, why would you bother changing out to VWRA? I think on two fronts. Firstly, I think it's the dividend withholding tax. It's lower for foreign investors like myself. I think from 30%, it's down to 15%. And I think secondly, it's about some estate taxes. Then I do adopt some sort of a dollar cost averaging approach where I buy VOO monthly. And you might ask, why not just buy VWRA every month? Mostly, it's because of the commission difference. If I buy stocks on the US exchange, they charge me a lower commission versus when I buy on the UK or the London exchange. They do charge a pricier commission, even though it's just $1. I think inherently I just don't want to spend more money. So what I tend to do is to DCA into VOO in some of these low-cost brokerages. And then I think every half a year or yearly, I'll just sell everything and then convert them to the VWRA equivalent. In terms of the third major change, I actually trimmed out my MasterCard position. I sold out everything and I added a small position or tiny position in Oxy. I sold out my entire MasterCard position. I think largely speaking, not because Master is a bad company. It's still one of the powerhouse in the financial industry. They have a duopoly with Visa. I think I just wanted to add them in times of crisis. When I look at the company now, they are, I guess, fairly priced, maybe even a little bit pricier. I do hope that if there comes a recession, I will add heavily to either Visa or Master or both. And I think I just wanted to redeploy the capital to somewhere where I feel that there is more value to be reaped. Next up, I think in terms of adding a tiny position to Oxy, so I don't profess to be an oil expert, and in fact, I do think that the commodity space is quite tricky to understand. But really what triggered me to add to Oxy was because of 2 points. Firstly, because Li Lu, which is one of Munger's best friends, has recently added to Oxy in the last quarter based on their disclosure. And secondly, Monesh, which is also a close friend of Charlie, he also added into Oxy in the last quarter based on their Wagon Pabrai funds or something along those lines. So I really just wanted to look closer into it. That's why I added a tiny position. It's not going to move the needle, but I think it kind of gives me skin in the game and I will be tracking closer to how Oxy is performing in the next few quarters or so. And I'll probably leave the link to one of the tweet threads that I saw that really kind of intrigued me, and to see this whole Oxy play more so like a leverage bond that give you crazy amount of dividend yield. On top of that, I also added to my Lulu position. I averaged down to under $300 per share. I also added to Amazon. I averaged up to under $140 per share. I think I added Amazon mostly when you saw that flash crash because of that Japan yen unwinding. I also added to my Haidilao position to under $15 per share, and I added to LVMH and I averaged down also to around $150 per share. So just to talk a little bit in terms of my portfolio overview, I do have a core position in the Chinese tech sector, which I've talked about. They make up more than 50% of the portfolio. So this too really determines whether I outperform the index or not. So fingers crossed, I do still feel that I have a relatively high conviction in both Baba and Tencent and how they're able to basically outperform the broader index if the Chinese tech play gets picked up again and investors get excited about the prospects of some of these big Chinese tech juggernauts. So for those of you who are interested in how they've performed in the latest earnings, I've already did a separate earnings breakdown in my 2 previous videos. And also, just yesterday, there was some good news that came out from the Chinese regulators saying that Alibaba has completed their 3-year rectification period. There are a few other positive news around Alibaba, which I think deserves a separate video. So this is not the focus of today's video. So coming down from that core position, I have the sub-core, which is in your Mag 7. I only own 3 of the Mag 7 names. I can also do a separate video on why I only own these 3 out of the 7. If you guys are interested, feel free to leave in the comments below. And on top of that, I also very thankfully or very fortunately caught TSM when it was in that down cycle, and it basically participated in that whole AI rally. So these 4 names also basically drove quite a bit of the returns of this portfolio that saved me from that Alibaba drawdown, especially in that 2022 so-called bear market because of inflation and interest rate, etc. I started scooping up some of these names and even averaged up along the ways. Third sub-core category, it's basically just my index exposure, nothing exciting. I just do a dollar cost averaging on the S&P, and then I switch them out to a world index periodically. So on the fourth part, which is my REITs exposure, I think REITs as a general subsector has been beaten down quite, I think in my opinion, unfairly over the last 3 years. They are still holding some of the best properties. They have some of the best pricing power. I don't necessarily look at them as some sort of a dividend play because I want the dividends, but more so I want to own some of these best-in-class assets in the Singapore piece of land. So that's why I added to them, and they have all performed relatively okay because of this recent rally in the dividend small cap REIT space, because we are looking towards interest rate coming down in the second half of this year. Like I said, all these are much more speculative in nature. I don't really understand them. I just add them so that I put them into my portfolio so that I monitor their earnings and see how they've been doing. That's why you don't really see me sharing my perspective on these 3 specific companies on my channel itself, because I'm still in the process of learning. So you can probably see them here, and then maybe 3 months down the road, you might see them gone in the portfolio. So lastly, in part 6, you can see that this is part of the losers gang, where I've been averaging down. I'm not too sure whether there'll be value traps or whether I'm scooping up a good deal. So part of this losers gang, I have Haidilao, Lululemon, and LVMH. So Haidilao and Lulu are the ones that took quite a beating, while LV, I'm kind of break even. So you're in luck. I think Haidilao and Lululemon has just reported their earnings in the last 2 weeks. That's why I'm going to do a quick breakdown in terms of how I look at their earnings and how I'm intending to position my portfolio moving forward. So firstly, let's talk about Lululemon. Lululemon post earnings. They actually reported their earnings Thursday after market hours, and Friday, which is the last candlestick that you can see here. I don't know whether is it too small. There's this very huge candlestick because I think when the pre-market it opened quite high, and then it started trading downwards, which I found it quite strange. Going specific into the earnings summary for Lulu, I think the bearish thesis is still strong. US customers are waning. It could be macro, it could be brand. I think this remains to be seen. But I think if it's a macro condition or if it's a macro problem, it's better for investors, because we all know that the economy goes through ebbs and flows. And if it's just a macro issue, when US comes back up again, the consumers are looking to spend again, then sure, I think Lulu will be a big beneficiary to that huge spending boom. However, if it's a brand-related problem, whether is it because of competitors or is it just because consumers in general not wanting to purchase or support the brand anymore, there's a chipping in terms of loyalty. I think those all have very different outcomes in terms of how I will back my capital in some of this position. To give you some high-level numbers, the revenue from the Americas region, they're up 2% year-on-year, but comparable sales is down 2% year-on-year, and this represents 73% of the total revenue. So US actually remained flat, while Canada was up 11% year-on-year. International growth is still strong, so China was up 37% year-on-year, comparable sales up 23%, and they represent 13% of the total revenue, while the rest of the world was up 27% year-on-year, and comparable sales was up 20%, 13% of the total revenue as well. So you can see that the Americas region, which is US and Canada, still represent the largest pie of Lululemon's revenue, and all these are considered on a constant currency basis. So specific to the Chinese segment, some concerns where this 37% year-on-year actually falls short, where it decelerated from Q1 of the 40+% year-on-year growth. So Canada is actually the most matured markets of Lululemon, but they still came in strong growth. But I think with these two past quarters, with US sales coming in slightly softer, it gives Lululemon a much easier base or much easier comparable to beat in the subsequent year or so. But I think the larger question, at least as a current investor, I think it's really this worry behind whether Lulu is losing its brand loyalty and brand fondness, or is it really just a macro issue that is plaguing the entire, I guess, consumer wearable or athleisure space. So the interesting thing is that Lulu actually recorded the highest ever gross margins in the entire company's history at 59.6%. But the biggest concern, it's still kind of dangling there, concerning most investors here. Lulu's management has been falling short on that front. So women's product growth actually slowed last quarter to under 10%, and then this quarter it was only up 5.7% year-on-year. And when you look at how the management team described the issue, they did say that it's part of their product plan. They introduce less newness across style. This idea of newness is not so much because of product innovation, but more so because of colors, because of prints, because of patterns, etc. And it was below historical levels that stem from earlier product decisions that has impacted conversion given the fewer new options. They're optimistic to see the benefits of these strategies no later than spring of 2025. And more importantly, to make matters worse, they just came out of that Breeze True drama, which was another type of leggings that they introduced. Quite a lot of missteps that came from decisions made probably 1 or 2 years ago, and they're paying the price. And likewise, you can see that the share price is basically tanking in lockstep. But I think in terms of how they're looking at the data that they're crunching and the prospect and the trajectory they're looking at, Lululemon is probably not going to be a quick trade. I don't think Lulu is going to recover like double in the next 6 months or so, but more so it might be a slow grind. But personally, as an investor, I'm looking at it at a long term. I'm not trading in and out of this position. I really do want to own a piece of this great brand, and I do think that Lulu still owns this huge brand equity. And considering the expansion in the rest of the world, if they're able to replicate what they've been doing so successfully in the US and Canada region, and I believe that they can continue growing if they are able to apply their playbook successfully. So that's basically my general investment thesis. But we are kind of in murky areas now. We are in the gray area. We don't really know, is it a macro issue? Is it a management issue that can be rectified? Or is it a brand issue that they slowly erode the trust from the customers? So it's either of these three buckets, and we probably have to continue monitoring. I think on the bright side, Lulu did bought back shares amidst the weak share price. They retired 1.9% of their shares outstanding this quarter, and on a trailing 12-month basis, they retired around 5% or 4.7%. They guided down for the full year, negative 3% from their previous guide. And also, I just wanted to give a quick shout out to Seeking Alpha. So for those of you who sign up with the link below now, you can get $25 off their premium membership, and you get a 7-day free trial. So this video is not sponsored by them, but personally, I'm an avid user of the platform. Let's say I'm bullish about Lulu. And when I look up Lulu in the Seeking Alpha platform, you get a range of analysis from both bulls and bears. And sometimes we are probably very afraid that we get very stuck up in our investment thesis and think that this company is the next best company after sliced bread. So sometimes I like to go into Seeking Alpha and just to seek a second opinion. And let's say I'm bullish, I want to look at what the bearish analysts are talking about. You can also look at different analysis piece. You can look up the past financial data. You can look at predictions, projections, etc., etc. So that's why I do use Seeking Alpha quite closely and intimately in my own investment process. And I do hope that you can benefit from the premium membership. So Haidilau's earnings summary, it's quite simple and quite straightforward. Just a few numbers that you kind of look at because they are still the typical restaurant business. So you basically just want to look at how they're growing their numbers. Are people spending more or spending less? And is the business more efficient? And are they able to leverage onto their brand to charge higher? So for the first 6 months, Haidilau's revenue was up 13.8%. And you go down the line, the second line item is actually raw materials and consumables. They are only up 9.1%. I think especially for a restaurant business, it's extremely important because it shows that you have kind of pricing power and you're not beholden by the high consumable prices increase. Whether is it because of the quantity increase or is it just purely from inflation. But the funny thing is, I do understand that in China today, largely speaking, actually a lot of these consumables are decreasing in price. They're experiencing some sort of a deflation. The not so good part is that staff costs increase much higher than revenue, which is 24% year on year. I think this is just a natural course of business. If you were to really understand Haidilau's business model, they really pride itself in terms of delivering the tip-top customer experience, and in order for them to do so, they have to pay top dollars, even for their waiters and waitresses. So table turnover, really it's just a measurement in terms of the efficiency that was improved, and it went from 3.3 to 4.2, and it's a mind-boggling number. I think even if you to compare it to just normal F&B industry. In terms of the breakdown in numbers, for Tier 2 and Tier 3, they jumped the most compared to the Tier 1 cities, from 3.5 and 3.2 respectively to above 4. I think they were sitting around 4.1 and 4.3. So that was really a huge, significant bump. However, I think the bigger looming concern, the dark clouds in the China economy is still there. Average spending actually fell from 103 RMB to around 97 RMB per customer table. So the Tier 1 cities actually fell the most, from 110 to 104. That's a negative 5.5% year on year. Tier 2 and Tier 3 actually fell roughly around 4.9%. So that basically just means that the ticket size, it's getting smaller, even though a lot more people are visiting these restaurants. And if you really try to kind of match the data points, whether it's from Baba, from Haidilao, or even from Yum China, all signaling similar kind of results. I'm telling investors that, hey, we are all increasing our volume, the intensity is increasing, but the ticket size is reducing. So you might still see top line revenue growth rates increase, but because of the smaller ticket size, that's why there is a kind of a pullback effect. And just because the intensity increase, you don't see the top line increasing in lockstep. And that's why I think if they do hold their average spending, I think revenue for Haidilao could probably come in at near to 20% year on year. So on top of that, Haidilao also issued an interim dividends of roughly a 3% yield on Friday's closing price. So the general conclusion for Haidilao, I think, is still the same for a lot of all these Chinese company that needs to ride onto the Chinese wave. So the business environment feels okay, economy is maintaining stability, so the profits of Haidilao were reduced due to some changes in taxation policy. They also said that they remain cautious in expansion and they still adopt a bottom-up opening approach, which is to make sure that whenever they open an outlet, it's net accretive to shareholders. So I think generally speaking, for many of these consumption-driven stocks in China today, they really rely on the consumer confidence, whether the Chinese consumers are looking optimistic about the future, whether they're able to spend more money. Likewise, I think if you really do buy into the whole idea that the property crisis is slowly turning the corner, the Chinese consumers are slowly turning the corner, then I do think that many of these companies, you'll see much better or much healthier results moving forward. So with that, I hope that I gave you a solid breakdown in terms of what I'm doing with my own investment portfolio today. So feel free to leave in the comment section down below on what you think, and I'll see you guys in the next video. But more importantly, I will see you on the moon. Goodbye.